Hello, everyone. Thank you so much for joining me today. We have some massive trends starting to appear in the US auto market, and I want to cover them with you. Let's not waste any more time. Let's just get started right away. Here are the largest trends that are starting to surface, especially in the United States auto market. You have trends around the legacy US auto manufacturers. You have trends around the UAW, which I'll cover exactly what that is shortly. You have the dealership network, and then you also have EV adoption. Real quick, when I say the legacy US auto, I mean General Motors, which is Chevy, GMC, and those brands. You have Ford, which includes Lincoln. And you have Stellantis, which is Chrysler, Jeep, Dodge, and Ram, plus a bunch of European brands. And when I talk about the UAW, what I'm referring to is the United Auto Workers Union, which is what those legacy automakers use to employ their factory workers in the United States. Let's get started with General Motors and cover some of their latest trends and why there might be some concern. So this is the Chevy Bolt. Cute little car. It's been around for a little while. It was first launched in December of 2016. And this was sort of heralded as a new generation for GM. They'll be able to introduce a car into the EV segment, and they started selling these in California almost 8 years ago, about 7 years ago now. This car, right around now, starts at around $27,000. And with the federal EV tax credit, you can buy this car for somewhere around $20,000 if you're eligible for that credit, if you're able to meet the income thresholds, which I believe is around $300,000 for married couples and $150,000 for individuals. Chevy sold about 200,000 Bolts of this globally since that car's introduction in 2016. However, this car has been discontinued as of the end of 2023. GM just announced this last week. And so GM's most affordable car is no longer going to be available for purchase at the end of this year. Now, GM says that the reason why they're discontinuing this car is because they're introducing new and better EVs in the Silverado EV, the Blazer EV, and the Equinox EV, which is really geared to that Bolt-ish area where they're launching this fall. And it's positioned as an accessible and affordable EV, offering added size, range, and technology. It's rumored to start somewhere around $30,000 to $35,000, but it will likely start much higher, given that automakers like to introduce higher trims first so they can make as much money up front as humanly possible. So we'll see if Chevy can ever reach that $30,000 to $35,000 figure. However, one key thing to highlight with the Bolt is that the Bolt has had some recall issues. The most famous of them was Chevy Bolt vehicles being recalled for fire. So fire issues with their batteries. All owners were urged to limit charging and park away from structures and more. This was back in 2021. It was heavily covered. In addition to that, the Bolt was not profitable. It wasn't making GM any money. Now, if we sort of review some of the previous EVs that GM has put forward, they had the EV1, which was released back in the 90s, and it was recalled after it became a little too successful. There's a lot of rumors why they canned it, but there's a great documentary on Netflix called Who Killed the Electric Car? It does look like GM was essentially forced to shut down the program because it was taking a lot of attention away from its profitable gas car business, which is obviously something that GM at the time probably wasn't very happy with. However, it's up for debate. You also had the Volt, which was voted, I think by Car and Driver, best car in America. This was discontinued in 2019 due to it not being profitable and not being as popular as GM had hoped. And again, you have the Bolt, which was discontinued as of the end of 2023. It's the most affordable car yet for EVs, but again, recall issues, not as much demand as they hoped, and it never was profitable. And then they also have this GMC Hummer, which is a very cool looking car. It was released, I believe, at the end of 2021 into 2022. However, this car only sold two Hummers. GM only sold two Hummer EVs in the first quarter of 2023. And so if you look at sort of GM's track record, it doesn't seem like GM has the best track record with EVs. The EV1 was canned, the Volt was discontinued, the Bolt is being discontinued, and the Hummer EV is not really going anywhere. So one would, I think, legitimately doubt GM's potential aspirations with their new EVs, but hopefully we can give them the benefit of the doubt. If you're enjoying this content so far, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you so much. In addition, if we look at GM's first quarter deliveries, so this is their entire first quarter sales by car for the first quarter in 2023 globally, we can highlight the EVs that GM has sold. They have the Bolt EV, which they sold about almost 20,000 of them in the first quarter. They also sold the Lyriq, which is Cadillac's electric SUV. They sold about 968 of them total. And then we have those two Hummer EVs that were sold in the first quarter. If you add up all those EVs for the first quarter, GM sold about 20,670 EVs total. But if you yank out the Bolt, which is going away, GM has only sold 970 EVs total in the first quarter of 2023 once you remove the Bolt. Just to put that in perspective of the biggest EV maker in the world, Tesla sold about 423,000 units in the same exact period, just to give you an understanding of the size disparity between GM and Tesla as it pertains to electric vehicles. Another way of looking at it, the Tesla Model Y, which is Tesla's best-selling car, which is an SUV, the Tesla Model Y had more units sold in Q1 2023 than Chevy Bolt's total sales for the entirety of the lifetime of that car, which is kind of a wild stat. Keep in mind that the Model Y is priced at about $50,000, which is almost really twice than what the Bolt charges today. And Tesla was able to achieve this with zero advertising and no dealership network, which some people think is a disadvantage, but in this case, it appears to be quite the advantage. So from an EV perspective, GM seems to be way behind. And if the transition continues to EV, which I hope to show with some data here shortly, then it seems like GM is going to really have to increase their efforts dramatically. Otherwise, they're going to be left in the dust quite badly. And you also have to remember that it took Tesla about 10 years to reach these current levels that they're at. And so how long will GM take? Can GM catch up to these levels? Are they going to be able to do it quicker? And if that's the case, I would ask, why haven't they done so already, especially when they've had different cars that they've introduced to be able to do that. So just some questions out there, open-ended, and I'd love to hear what you think in the comment section below as it pertains to GM specifically. Now let's cover Ford, which is another legacy automaker in the US. Ford has two electric vehicles. You have the Mustang Mach-E and you have the F-150 Lightning pickup truck. Two great looking cars, and I will give Ford props. These are some legitimately good cars that had been selling somewhat well in the US region. It's by far the most developed EV lineup of the three legacy automakers between Ford, GM, Stellantis, and they are continually trying to ramp their EV sector. Ford is. However, as of the latest quarterly report from Ford, Q1 of 2023, they said that they sold about 12,000 units in the first quarter of 23. A lot of that was due to plant shutdowns, but it's still kind of worrisome that such a fast-growing segment had such a large dip from the fourth quarter, and it was lower than the previous year's quarter of 18,000. But the bigger issue here with their EV segment is that they have negative 102% gross margins, which is obviously a huge loss. It equates to about $700 million lost for the first quarter, specifically in their EV business. The other way to think about that is that Ford loses more money on EVs than what it charges. It charges about $58,000 on average and loses $60,000 per car sold, which means that their costs are somewhere in the $120,000 per car built, which is obviously not good. Now, obviously, this is a large money losing business for Ford at the present time, but Ford has hopes to increase its ramp to really get the scale going to lower the cost of these cars, as well as improve costs for those vehicles that they're building now. Now, there were two comments that were made from Ford in the first quarter earnings call for 2023 that I want to cover with you, so you have a good understanding of where the Ford leadership is at from the standpoint of their electrification efforts. I'm going to go ahead and play the first clip, and then we'll review quickly what was said.
As a first mover, we felt it was important to get to market quickly. We've readily admitted that the design and efficiency of our first generation products isn't where it needs to be, and we're working on those reductions now. And we're taking all the learnings from that and incorporating it into our second generation products. And we'll talk more about that in a couple of weeks at Capital Markets Day. So, yeah, there's things you can do. You just need to be thoughtful about it as you go through the product. And where there's opportunities, you bundle them together. You do a minor launch, you do a change, and you go. And that's what we're doing on E. And we're using the connected data to take out features that the customers don't value.
So as I'm sure you've heard from the leadership crew at Ford, Ford is admitting that its Mach-E and Lightning cars are too expensive to build currently, and they're doing everything they can to reduce costs as much as humanly possible. And one of the primary ways Ford will look to do this moving forward is by moving to the next generation products after Mach-E and after Lightning. However, with that comment, what that implies, what I'm hearing is that the current lineup is obsolete, meaning that they're not going to be able to make money with the current lineup, and they're going to have to figure out how to move to the next generation as quickly as humanly possible. And if they do make money with the current lineup, it's likely not going to reach anywhere close to the hopes they have for that business, which is 8% margins by the end of 2026. Now let's go ahead and listen into another comment that was made specifically around its electrification efforts with that Ford Model E business and what Ford's plans are from a strategic perspective. Let's go ahead and take a listen.
So you should expect that a lot of that capacity we're putting in is for growth for the company, but we are not going to grow at any cost. We're going to manage that incremental new growth for profitability and growth together. And we put a lot of thinking into our product strategy. One of the most important aspects of our product strategy is not to have too much top hat engineering. We want to have a lot of scale per top hat. And again, we'll go into this capital markets day, as you said, because I think it's best to answer there with real examples where you can really see our strategy coming to life. But we've learned a lot from Lightning and from Mach-E. Frankly, the number of new customers we're seeing is very encouraging for us because of our capacity increase. And we know that the second cycle product can be radically simpler and lower cost.
I'm sure you heard that reiteration that the next generation products is really going to help them lower the cost. But there's a key nugget from that commentary that I really want to highlight, which is Ford will not grow at any cost when it comes to their EV division. And I think this is a very important thing to hone in on for the rest of this video. There was also another comment that was made around this, which is a little bit contradictory, but I'll highlight it anyway. Ford wants to be balanced between growth and profitability. They want to be able to grow their business, but they want to do so profitably. Growing at all costs is going to be tougher to do that. You'll get way more market share, meaning you'll sell a lot more cars, but it might take you way longer to make money. But it's clear that Ford said, we're not going to do that. We're going to try to grow, but we're also going to ensure that we're profitable, that we increase our ability to make money as much as possible. And we shouldn't be surprised. They're making negative 102% margins on that business. Now, I'd like to propose this question, and you tell me what your thoughts are about this. If Ford isn't growing EV at all costs, doesn't that mean that they'll shrink significantly, right? If Ford isn't doing everything it can to grow the next generation of vehicle, doesn't that mean that the rest of the business is going to shrink, which means that Ford's entire business will shrink? And I want to go through some data to kind of highlight that, because I really think that's a worrying comment if I'm a Ford investor, which I'm not, that tells me that Ford's long-term aspirations are not about being a mass market vehicle maker. It's about niching down and really honing in on the things that are important. Real quick, if you do want to support the channel, I have a coupon for Athletic Greens in the description below, which is a supplement I use every single morning. You'll get free travel packs and vitamin D. Thank you for your support. And I also have merch to a link to my website as well. You can get shirts, hoodies, and stuff like that. Thank you so much for your support. Really appreciate you. So why is this such a big deal? So if we look at the EV trends and hybrid trends, but mostly EV trends, which is what's tagged as BEV from 2010, there we go, you can see that the yearly growth for a global electric car stock in selected regions, which is China, United States, Europe, and other, you can see that there's a dramatic increase starting around 2016. And this thing's basically going exponential, which means globally there's a lot more electrification happening on the fleet. In the US BEV, which is the battery electric segment, which is what the Lightning and the Mach-E are in, which is sort of this dark greenish color, whatever this color is, you can see there's been steady increase from 2018 to 2019, 2020, 2021, 2022, and even more so in 2023 with the federal incentives around EVs. So you'll see this accelerating in the US. Another trend that we're seeing around accelerating electrification is that the Tesla Model Y, as of the first quarter of 2023, is the best-selling SUV and the best-selling non-pickup truck in America, period. Not best-selling EV or anything like that, but best-selling vehicle, period, that is not a pickup truck, which again points to a lot more people are purchasing electric vehicles faster, and it's happening way quicker than a lot of people thought, especially 5 years ago. Another trend I want us to look at is that the yearly US auto sales from 2016, which you just saw, are a huge majority gas cars, has been on a steady decline from 2016 all the way down to 2022. Of course, we had COVID in this area here, but there's been significant decline from what was called peak auto around 2015, 2016 to where we are now, from about 17.5 million to about 13.8 million from 2016 to 2022. So there's been less gas cars being sold every single year, and there's not a lot of plans to make this thing go higher, especially given the current trend in the economy with the Fed raising rates. And so the trends seem very clear. Gas cars will continue to shrink, especially in the United States, and EVs will continue to grow. So you're going to have this thing happening, right? If this is the gas car and this is the EV, it's starting to come like this. Right? And so the speed of each one of those things, the gas car shrinking and the EV taking off, will dictate legacy auto survival into the coming decade. And so if this is happening and Ford is not really committing to growing its EV sector at all costs, where will Ford's growth come from? Where is Ford going to be able to grow its business to ensure it's still profitable and selling more cars than it did previously so it can make more money and stay alive as a business, right? And this is where it gets super weird for Ford. Ford Blue is Ford's gas car business, and Ford Pro is its commercial business. This is how much money the company made in the first quarter of 2023. Ford Blue, its gas car, made about $2.6 billion. Its Ford Pro commercial made about $1.4 billion, and its EV lost about $700 million. However, what we just reviewed is that this part of the business and this part of the business is going to keep shrinking. And this part of the business is going to become bigger, right? But they're not planning on growing this part of the business as fast as humanly possible. So what does that mean? I'm just going to open-end the question. I don't have a crystal ball. Hopefully you do. So what happens as the money-making business dwindles? That's a legitimate question for these legacy automakers, especially if their plan isn't to grow electric vehicles at all costs, given the overall trends in the market. Especially if EV adoption is soaring. The faster this is happening, especially with players like Tesla and others, that means that those companies are going to be able to take more market share away from Ford and GM, that those companies might be too slow to get, which means that by the time they decide to get into EVs, it might be too late, right? It might be too late, which is obviously a huge concern. Now, as it pertains to Ford losing money on its EV business, I think it's very important to highlight that Tesla also went through a very similar sort of time in its history back, 2014, 2018. Highlight something from 2014 here. Here's how much revenue they made, which is similar to how much Ford made in the first quarter of 2023. And Tesla lost about $28 million on $700 million of sales, nowhere near close to the 102% negative margin that Ford was losing, but Tesla was still losing some form of money. The most amount of money that Tesla sold in its history was around March 1st or March 31st, the first quarter of 2018, about 5 years ago. They had about $2.7 billion in sales, and they lost about $600 million in that one quarter, which is very similar to Ford's $700 million that they sold in the first quarter. However, Tesla was able to sell way more in revenue. And so their negative margins was around 20% instead of 102. So Tesla's margins was about negative 22% EBIT margin versus negative 40 to 102% for Ford. So from this perspective, right, it seems like Ford is behind. Ford appears significantly behind on profitability and isn't willing to maximize its growth, which is what Tesla as a proxy did, and that enabled them to become profitable way faster on its EV business. And Ford is saying, nope, we're going to focus more on profitability and we'll manage our growth with that profitability, which again, it doesn't jive. I don't quite understand that message still. Hopefully one of you guys can give me clarity in the comment section. And so if that becomes true, is Ford no longer aiming to be a mass market vehicle maker? And instead, with the verbiage around we're going to focus on profitability, are they going to get more into just electric pickup trucks only, or super fancy schmancy electric vehicles where they're only going to sell maybe 100,000 units a year instead of 4 million units a year, which is what Ford is doing now? Again, open-ended question, but that's what it seems like to me based on what the company is saying. The third legacy automaker in the United States is Stellantis, Ram, Jeep, Chrysler, Dodge. These are the brands. I didn't even know I had a slide in here that said the brands, but these are the brands. However, the big gap with Stellantis, and this one's going to be a very quick one for this brand, they have 0 EV sales. So Stellantis is like, within the US, we're just going to wait it out. We're going to see what happens, and hopefully it works out. That's the kind of vibe I'm getting from that company. However, they do have EVs launching in 2024. They're going to start with their EV pickup truck. I think the Ram 2500 or 1500 EV version something, but it's going to be very, very expensive. It's going to start probably well above $80,000. So the question becomes, is Ram going to be able to sell those in any meaningful volume? GM was only able to sell 2 Hummer EVs in the first quarter of 2023. What's Stellantis going to do in the US, especially if the economy slows down, which we've kind of been seeing with the Fed rates going higher. Now, as it pertains to the United Auto Workers Union, which is the union that Stellantis, Ford, and GM leverages or partners with to run their factories, they're not very happy. They're not very happy. These guys represent factory workers at US Legacy Auto, and they're not very happy right now. And the reason why is really based around the movement to electric vehicles and some of the policies that the United States government has put in place to stimulate that movement towards EVs with EV tax credits. Here's a statement from the UAW on job cuts at Stellantis, which is, again, we just talked about them. This was from April 26, 2023. I'm going to read this just to give you an idea of how the labor force union is feeling about this transition. Stellantis' push to cut thousands of jobs while raking in billions in profits is disgusting. This is a slap in the face to our members, their families, their communities, and the American people who saved this company 15 years ago because they got bailed out during that financial crisis. Even now, politicians and taxpayers are bankrolling the electric vehicle transition, and this is the thanks the working class get. Shame on Stellantis. Our union is working around the clock to get justice for the members impacted by these job cuts. We look forward to Stellantis doing the right thing by the workers who make this company run. And so here's another statement. If that wasn't concerning enough for Stellantis, UAW not yet endorsing Biden for second term, citing EV policies. Again, this rhetoric around EVs. GM Ultium battery workers start at $16.50 an hour with a raise to $20 after 7 years. Here is an excerpt from that article highlighting what the union president was saying. United Auto Workers President Sean Fain said that Detroit-based union is not yet endorsing Joe Biden for a second term, citing concerns about electric vehicle policies. The federal government is pouring billions into electric vehicle transition with no strings attached and no commitment to workers. The EV transition is at serious risk of becoming a race to the bottom. Make sure you keep this line in your head real quick, a race to the bottom. We want to see national leadership have our back on this before we make any commitments. So that's the union rhetoric in 2023 around electrification, specifically in regards to legacy automakers with Stellantis, GM, and Ford. Okay? A race to the bottom in this case, and this is really my biggest takeaway, and the way that they're saying this obviously implies lower costs necessary. This commentary, for sure, speculation, but I'm willing to bet a lot that this is due to Tesla's latest moves around cutting prices on electric vehicles, which is putting huge pressure on legacy automakers to do the same. Now, if they want to do that, that probably means cutting jobs, right? Lowering your labor force, maybe taking some pay cuts in places, but ultimately what happens is they'll have less workers, and all these workers are unionized. And so the union hates hearing that, hates hearing a race to the bottom, because that means less jobs because they have to cut costs, right? And of course, if the UAW gets their way, the outcome from this is for sure going to mean higher costs for Stellantis, for GM, and for Ford. Why is that? If they get their way, they're either going to get increases in labor costs or increases in pay, which is going to increase the cost associated to the EV transition, which is going to make it even harder for companies like Ford to transition to EVs, given that they're already losing 102% margin on their cars, or $700 million right now in the first quarter of 2023. Or if the UAW doesn't get its way, they're going to start doing strikes. They're going to start throwing a fit. And what does this mean? This means disruption from strikes to the factories. Ford won't be able to operate their factories. And of course, that means gigantic amount of lost sales, especially if this becomes a very serious dispute. And this has the potential of being so given a slowing economy, the Fed raising rates, the EV transition. It seems like the perfect storm is brewing for the UAW and the legacy automakers to get into a pretty severe fight. We'll see. Then you also have to think about this. What is the union's incentive to move as quickly as possible towards EV production, right? That's a very important question to keep in mind as we think about a unionized workforce in a factory environment in the 21st century as we're moving towards electrification. So why is that? EVs have less parts, which means that they require less human labor. And if they require less human labor, that means that union gets less dues, right? The people working there won't pay into the union nearly as much. And so the union has zero incentive to support a technology that's going to bring them less dues. The incentive structure is completely misaligned. And every single legacy automaker has this sort of structure that they have to work around with the UAW. Pretty damn difficult, if you ask me. The incentives for the EV transition are not aligned. They are misaligned, especially with the unionized workforce in the United States in factory environments. This is my opinion. I would love to hear your thoughts in the comment section below. Lastly, let's hit the dealership network. If this wasn't enough, sorry this video is so long, but there's just so much. There's so much to cover. The dealership network is another piece of the puzzle that is specific and unique to the legacy automakers that's becoming a hindrance and a huge liability for them to be able to get into electrification. And this is why. Legacy automakers have to sell through dealers. They cannot sell directly to customers in the United States. They have to sell it to a dealership network, and then the dealership network is there so you can go there and haggle with them and then leave unhappy 9 out of 10 times. I'm sure all of us have had that experience, right? But legacy automakers are forced to sell their cars to the dealership network. So if you think about it, in respects to EVs and the dealership network, dealers have little incentive to sell EVs due to low maintenance required. Given the lower part count on electric vehicles, this applies to every single electric vehicle, their maintenance is going to be way less, which means that dealerships are going to make way less money if they sell EVs, because they won't make up their profits on the back end when you have to bring your car in for an oil change you'll never have to do, for a transmission you'll never have to replace, for an engine you'll never have to tune up, so on and so forth, right? So the dealers, again, it's a misalignment of incentives between this transition and the dealership network. Legacy Auto has a lot going on, man. And then you have this comment from Car Dealership Guy, @GuyDealership on Twitter. Phenomenal account to follow if you want to track the auto segments in the United States. He just recorded a great podcast with somebody, I guess, and I'm very excited to hear about this. But I want you to read this statement, which is fascinating. It talks about the current dynamic between the dealership network and legacy auto. So he has acquired 15 franchise dealerships in the States. Interestingly, he said the only brand he refuses to acquire is Ford. And why is that? Ford's leadership has severely breached trust with dealers. Why put your hard-earned money behind leadership that wants to bypass you? We can argue all day if he's right or wrong, but one thing is for sure, if he thinks this way, you can betcha other dealers are feeling the same way. And here's the thing, his perspective isn't even contrarian. The data also supports it. Kerrigan Advisors recently reported that dealer demand for Ford stores is declining. So is it time for Ford to rethink its strategic direction? And this is directly tied to Ford wanting to go direct to customers to bypass the dealership network, because they know the incentive structure is misaligned. But here is the problem. The one legacy automaker that's trying to fix this misaligned incentive structure is being punished on its money-making business. Dealers are saying, you are trying to go behind my back to sell EVs that we don't want to sell, right? So screw you, we're not going to sell your cars, period. That seems like a pretty, that seems like trouble to me. I don't know how widespread this is. It's going to be fascinating to play out, but I'm sure this dynamic is a lot more prevalent than folks might imagine. And I'm constantly talking to folks that are experts in dealership networks and things like that to really get a good understanding of it. And I think we're starting to get the beginnings of this sort of fomenting thing that's happening. So it's going to be fascinating to see what happens. Okay, let's review. I don't even know how long we've been going for. Feels like half an hour. We'll see. This is what legacy automakers are dealing with. GM has poor EV track record with the EV1, the Volt, the Bolt, the Hummer EV. These are all cars that launched, promised a lot as EVs, and didn't do too well. And 3 out of those 4 were recalled and or canceled. Okay, so not the greatest track record. Ford, which is the one that's actually trying to advance to EVs as quickly as humanly possible, isn't trying to grow it as fast as humanly possible, and they're losing money on EVs way more than its closest competitor, which is Tesla, at the same time in their history. So that's another thing Legacy Auto is dealing with. Stellantis has no EVs. They're like, we'll see what happens, right? We'll bet our farm on the gas car. Hopefully that works out. The UAW, the United Auto Workers Union, is upset about EVs. They don't want to go to EVs because that means less dues. And so we better work something out, which probably means higher costs for legacy automakers if it does pan out. Otherwise, you'll see strikes, guaranteed. I'm willing to bet on that. Dealers hate EVs and Ford. Poor Ford. They don't want them. Again, a misaligned incentive structure. They don't want to they don't want to sell EVs because they can't service them. And the one automaker that's trying to bypass that gets punished by dealers saying, I don't want to deal with you. You figure it out. Okay. So that's kind of strange. And then the last overall trend, which really impacts every single one of these, if none of these sort of points really jumps on the wagon, is going to be a huge issue. And that is the world is shifting to EVs. The trend, I believe, is quite clear. And every single one of these things right here, which are tied directly to legacy automakers, is in direct opposition to this. And these are not small things. These are very large structural things, right? But what do you think? What do you think? This is my opinion. This is my data set. Really long video. I apologize, but there's just so much. I think all of these things tie together very closely. But I really want to hear what you have to say about this whole thing. I'm getting more and more new viewers that are maybe new to the world of EV, and they're trying to understand what's happening a little bit better. And my goal really is to try and bring as much visibility as humanly possible from what I'm seeing in the auto market. And if you're enjoying this type of content, I would love it if you click the subscribe button so you can see more content like that from me in the future. I really, really appreciate your support. And yeah, just a fascinating time that we're living in. And I can't wait to see what happens, man. I can't wait to see what happens. Thank you so much for watching this video. Hope this video was informative and helpful. And we'll see you on the next one. Take it easy, everybody. Bye-bye.